Lease accounting, right? We say that. A lease is a contract. A lease is a contract. A lease is a contract or part of the contract. A lease is a contract or part of the contract. A lease is a contract or part of contract. The contract or part of the contract that conveys the right, that conveys the right to use, that conveys the right to use an asset, that conveys the right to use an asset, that conveys the right to use an asset for a period of time, that conveys the use of an asset for a period of time, in exchange for a consideration, in exchange for a consideration, in exchange for a consideration known as lease rentals, in exchange for a consideration known as lease rentals, Full stop. It's a contract between two parties. 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 Where one party is a contract between two parties, where one party known as the lessor, where one party known as the lessor, where one party known as the lessor, in bracket owner, lessor in bracket owner, gives another party known as the lessee, gives another party known as the lessee the right to use an asset, gives another party known as the lessee the right to use an asset, and enjoy all the benefits, and enjoy all the benefits, and enjoy all the benefits, and enjoy all the benefits and risks, and enjoy all the benefits and risks, and enjoy all the benefits and risks associated with the utilization, all the benefits and risks associated with the utilization, of the asset, associated with the utilization of the asset, Full stop. Another point. In order for such contract to exist, comma, the user of the asset need to have the rights to, needs to have the rights to, semicolon, past bullet, obtain substantially all the economic benefits, associated with the asset utilization, And the second bullet, right to direct the use of the asset, So that's what we call a lease. It's a contract between two parties whereby one party known as the lessor. Now, the lessor is the owner. Now, for example, assume that it mostly happens when you are given a contract maybe for 3 years, whereby for you to do that contract, you as the contractor, you need some assets, some machinery like excavator, all that. You need bulldozer. You need some lorries. Now, in that case, instead of investing by buying, you just approach a company. You tell them that I need 2 excavators. for the next 3 years. So that means you don't own it, but you need it to use it in your contract. So that means you approach a company, now that's the owner, who will give you now the right to utilize. So you become the lessee. It will be given now the excavator to use it for the next 3 years. So that means you as the lessee, you are the one who will be enjoying all the benefit associated with the utilization of the asset. But in return, you'll be paying the owner. That exchange is what we call now the lease rentals. And since you are the one enjoying the benefit of this asset, you don't own it, but you are controlling it. So therefore, you as the lessee, you recognize that asset as your asset. Why? Because an asset is something that owned by a company or an individual that you expect some future economic benefit. In this case, you have leased. You don't own it, but you are the one controlling it. You are the one enjoying all the benefits. So therefore, in this case, you'll be recognizing what we call the right of use asset as part of non-current asset. But since also you made a commitment that you'll be paying, whenever you expect an outflow, it becomes liability. You don't own it, and you made a commitment you'll be paying the lease rental. You'll also need to recognize it as well as a liability. So now let's look at types of leases. Types of leases. Type of leases. And number one, we have what we call operating lease. Number two, we have capital or finance lease. Number three, we have leverage lease. And number four, we have sale and leaseback lease. Those are the 4 types of leases. Now let's start with the first one, operating risk. Operating risk. Operating risk. Now let me first of all explain the difference between the 4. Now, an operating risk, this is a short-term lease. Yeah, it's a short-term risk. Then we have the capital or the finance risk. Now, for the finance risk, this is a long-term lease. Then we have a leverage risk. Now, a leverage risk, this is a risk whereby the underlying asset and the lease has some financial obligation outstanding. That means, for example, in this case, the owner of this company had taken a loan of 10 million to buy a machine. And then you as the lessee, you have leased that machine. But taken a loan to buy a machine, then you lease that machine. So that means you'll be paying the lease rental to the owner, and then the owner uses that lease rental to go and finance the loan. So that's what you call a leverage risk. This is a risk whereby the underlying asset and the lease has some financial obligation outstanding. And therefore, in this case, there will be 3 parties. The lessor, the lessee, and then the financier or the bank. And then number 4, we have sale and leaseback risk. What's the sale and leaseback risk? Now, this is where the owner of the asset decides to sell the asset at the lease. You sell the asset, you get the capital, and then later you lease it back. That means in this case now, you are the one who will be paying the lease rental. I will start with the operating risk. Is that? This is a short-term risk. This is a short-term risk, and it has the following characteristic, and it has the following characteristics, and it has the following characteristics. It has the following characteristics. Number one, the lease period is very short. The lease period is very short. Relative to the economic life of the asset. Relative to the economic life relative to the economic life of the asset. Number two, there is contract can be cancelled. There is contract can be cancelled by either party. There is contract can be cancelled. There is contract can be cancelled by either party anytime before the end of the lease period, anytime before the end of the lease period, anytime before the end of the lease period. And number three, the lessor in bracket owner, the lessor in bracket owner incurs operating and maintenance costs incurs, so that the owner or the lessor incurs all the operating and maintenance costs associated with the asset, associated with the asset. And number four, there is C, is not given an option the receipt is not given an option to buy the asset. It's not given an option to buy the asset. The receipt is not given an option to buy the asset at the end of the lease period. At the end of lease period. At the end of the lease period. At the end of the lease period. So that's all about an operating lease. Number two, finance risk. Finance stroke capital risk. Finance stroke capital risk. Finance stroke capital risk. Right to say that. This is a long-term risk in nature. This is a long-term risk in nature. This is a long-term risk in nature. Full stop. It has the following characteristic. It has the following characteristic. That these are long-term risk in nature. So it has the following characteristics. So what are some of the characteristics of a finance or the capital risk? Number one, the lease period is at least, the lease period is at least equal to 75%. The lease period is at least equal to 75% of the asset economic life. Of the asset economic life. Of the asset economic life, at least 75% of the asset economic life. Number two, there is contract. There is contract cannot be cancelled. There is contract cannot be cancelled by either party. Cannot be cancelled by either party. There is contract cannot be cancelled by either party before lease period matures. Before lease period matures. Before lease period matures. Number three, there is C in cars. There is C in cars. There is C in cars. All the operating and maintenance costs. There is C in cars. All the operating and maintenance cost of the asset. Number four, there is C is given an option, there is C is given an option to buy the asset. There is C is given an option to buy the asset, at the end of the lease period. It's given an option to buy the asset at the end of the lease period. At the end of lease period. At the end of lease period. Now that type of risk is leverage risk. Leverage risk. What do you mean by average risk? So that this is a type of risk. This is a type of risk. This is a type of risk whereby the asset under risk, whereby the asset under risk, whereby the asset under risk, the asset under risk has some financial obligations. The asset under risk has some financial obligations, has some financial obligations outstanding, has some financial obligation, has some financial obligations outstanding, has some financial obligation outstanding. Good. Then lastly, number 4, sell and lease back lease. Sell and lease back lease. Sell and lease back lease. What is that? So that is a type of risk. Is a type of risk. Is a type of risk. It's a type of risk. Is a type of risk where there is so where there is so where there is so there is so is the risk is the owner where there is so sells the underlying asset, sells the underlying asset, sells the underlying asset, sells the underlying asset, and then lease it back, and then lease it back, and then lease it back, and then lease it back. Yeah, so that means now the ownership will turn. So the lessor becomes the lessee. Good. Now let's look at some advantages of lease. Advantages of leasing. What are some of the advantages of leasing an asset? Yeah, for example, now assume the same contract whereby you needed, for example, an excavator as a contractor. You are given a contract for 3 years whereby you needed an excavator. Now, the cost of the excavator, let's assume it will be 10 million or 15 million, of which you don't have. Because whenever you're given a contract, what happens? You are paid after the contract is done. That's how it works. It's not that the owner gives you all the money, no. But the cost, if you are to buy your own, is 10 million. But if you lease, you only need to be paying the owner 1.5 million per annum. You don't own it, but you'll be using it, but at an annual rental fee of 1.5. Now, what are some of the advantages of this instead of this 10 million? Number one, lease does not require significant initial outflows, does not require significant initial outflows compared with the cost of buying, compared with the cost of buying. Number two, lease does not involve strict terms and conditions, does not involve strict terms and conditions associated with long-term debt, Number three, leasing has a lower effective cost. Leasing has a lower effective cost compared with the long-term loans. Another one, number 4. It reduces the risk of obsolescence. Good. So those are some of the advantages of risk. So now let's look at accounting for risk. by the receipt. Accounting for risk by the receipt. Accounting for risk by the receipt. So it's that number one, the initial recognition. If you risk an asset, so how do you recognize it initially and subsequently? Start with initial recognition. Initial recognition. Initial recognition. To say that initially, in bracket, at the commencement date, initially, in bracket, at the commencement date, comma, the receipt recognizes, semicolon, A, lease liability, and number B, right of use asset. The receipt recognizes A, lease liability, and B, right of use asset. Now let's start with A, lease liability. Lease liability. See that? Lease liability will initially be measured, at present value, of lease payments, not paid at the commencement date. Lease payment not paid at the commencement date. Present value of lease payment not paid at the commencement date. Discounted using the interest rate of the lease. Discounted using the interest rate of the lease. Using the interest rate of the risk, discounted using the interest rate of the risk. Put in bracket, fair value of the asset, Then number B is the right of use asset. Right of use asset. See that? The right of use asset, shall be capitalized. The right of use asset shall be capitalized, and it will include, shall be capitalized, and it shall include, semicolon, first bullet, lease liability, second bullet, payments made in advance, i.e. payments made in advance, i.e. at or before lease commencement date. Then number 3, initial direct cost. Now, reason up here, I explain what we mean. by recognition of this risk. So you're saying that number one, in this case, if you lease an asset, now the owner of the asset is who we call the lessor. Then here, if you lease, you become the lessee. The lessee. Now, how does the lessee account for this asset? In this case, you don't own the asset, but you have leased the asset to enjoy the benefit and to use the asset. So in that case, you have to recognize two things. Number one, you have to recognize a lease liability. As well, we are saying that you also need to recognize an asset. That's the right of use. Right of use assets. What's the difference? Or why are you showing as an asset as a liability? Number one, we are showing it as an asset because what is an asset? You see that an asset is anything that is owned by an individual of the company of which you expect some future economic benefit. So you lease this asset so that you can use it to generate revenue. So therefore, it qualifies to be an asset. You capitalize. But on the other hand, you don't own the asset, but there was some obligation. You say that I lease the asset, you give me the asset, I don't own it, but I'll be paying you at the end of the year or at the end of the month. So since I made a commitment, I'll be paying. Whenever the company expects some future outflows, it becomes a liability. You don't own the asset, but you're enjoying the benefits. It makes it to be the asset. But since you made a commitment, you expect to be paying the lease rental, it becomes a liability. You have to show the lease liability. And we're saying that, how do you determine the lease liability? Lease liability will be measured at present value of lease rentals not paid at the commencement. For example, this is what I mean. If you have to lease this asset for 3 years, and you agree that each year will be paying 1.5 million, that's what we agreed, at an interest rate of, because there will be monthly an interest because of time value of money, maybe at an interest of 10%. So how will you recognize the lease liability? I think that is the present value of lease rentals not paid at the commencement. So you'll take 1.5 each year, then you discount to determine its present value. You discount, and you know how to discount. So in this case, we'll be taking 1.5 million present value interest factor of an annuity. The interest rate is 10% for 3 years. So it will be 1.5. How do you discount? That's what we call the time value of money. It's 1 minus 1 plus R raised power negative N over R. Now, this is the formula of getting the present value of an annuity. What about the right of use asset? You're saying that when determining the right of use asset, so right of use asset, it will be made up of 3 elements. One, the lease liability, what we have computed here, the present value of any future economic benefit or future payment. Then you add also payment in advance. We have some contract whereby you have to pay upfront. So that means you'll be paying the lease rentals at the beginning. It's like rent. For the rent, you don't pay at the end, you pay at the beginning. So you pay any payment you have made in advance, and then any initial direct cost. For example, you engaged a lawyer, those order processing or all those legal fees, any cost you incurred prior to the actual use of the asset, you also capitalize. Now, what you get here is what you take it now to the balance sheet as the value of the asset. And being a machine, you also need to depreciate. Now the question is, how do you depreciate? So you'll be depreciating this asset, this right of use asset, based on the ROA of, number one, the lease period, and the asset economic life. Asset economic life, the ROA of the two. If you lease, for example, for 3 years, but the economic life was 4 years, how will you depreciate this asset? So you depreciate this right of use asset for the next 3 years, not 4 years. So I want you to show this right of use asset. Just show this. Write this, copy this. That to get the right of use asset, show that. Another paragraph, let me say that. The right of use asset, the right of use asset, the right of use asset, the right of use asset will be measured subsequently, will be measured subsequently, will be measured subsequently, will be measured subsequently at cost, at cost, at cost, at cost, less accumulated depreciation, at cost less accumulated depreciation and impairment losses, less accumulated losses and impairment losses, at cost less accumulated depreciation and impairment losses, in accordance with the cost model, in accordance with the cost model, in accordance with the cost model, in accordance with the cost model of IAS 16, IAS 16, IAS 16, PPE, IAS 16, PPE, yeah, plant, property, and equipment. How do you measure them subsequent? Good. Now the question is, how do you depreciate it? How do you see that? The right of use asset, the right of use asset, the use of, the right of use asset, the right of use asset shall be depreciated, the right of use asset shall be depreciated, based on the row of, 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 semicolon, a lease period, lease period, lease period, lease period, B, asset economic life, asset economic life, asset economic life, asset economic life, asset economic life. Good. So now I want us to do an illustration. May 2018. May 2018, question 4B. Royal Contractors Limited owns an item of plant used for construction with a carrying value of 14 million as at 31st of December 2015. The carrying value is the same as net book value, the amount shown in the financial statement. Then you are told that the firm won a construction contract and decided to sell and lease back the machine on that date under the following conditions. Number one, selling price is 40 million. This was also the fair value of the plant. Number two, lease rentals payable annually in arrears amounted to 15,521,200. Then number three, lease duration for the machine was to be 3 years. The economic life of the machine was also 3 years. The implicit interest rate was 8% per annum. Required. Journal entries record the necessary transaction in the book of Royal Contractors Limited for the 3 years, including the expected entries for the end of year 2018. So how do we account for that? Now, Royal Contractors, they owned an item. Can we read that again? That Royal Contractors Limited owns an item of plant So railway contractors owns an item of plant used for construction with a carrying value. Now we think that carrying value is the net book value, the amount shown in the financial statement of 14 million as at that 1st of December 2015. The firm won a construction contract and decided to sell and lease back the machine on that date. They are the owner, but now they got a contract. So they decided they sell the asset, they get more money, then they lease. If you lease, you have an option of paying mdogo mdogo. So which is one of the good strategy. So under the following condition, number one, selling price 40. So number one, there was gain on disposal. Because the selling price is 40 million, but the net book value of the carrying amount was 14 million. So that means there was a disposal gain of 26 million. Then lease rentals payable annually in arrears amounted to 15,521,200. That's what they agreed they'll be paying. Lease duration for the machine was to be 3 years. The economic life of the machine was also 3 years. So the economic life and the lease period were the same. The implicit interest rate was 8%. So how do you account for this? We say that the first step is to determine the lease liability. And this lease liability is what we call the fair value, of which you're already given. And only the first bullet. The first bullet, you're told that selling price is 40. This was also the fair value of the plant. But nowadays, you will not be given the fair value. You will not be given the fair value. It's upon you to determine by taking into consideration the present value of lease rentals not paid at the commencement. That's the definition I give you on lease liability. See that lease liability will be determined based on the present value of the lease rentals not paid at the commencement. So in this case, we agreed. Kindly don't copy when I'm teaching, just listen. You'll take 15,521,200. These are the lease rentals. This is what you'll be paying at the end of each year for the next 3 years. So you discount present value interest factor of an annuity. The interest rate is 8% for 3 years. So therefore it will be 15,521. Just do it here. 15,521,200. 1 minus 1 plus R. R is 8, 0.08. Raised to power negative n. N is 3 over R, 0.08. Now compute that for me. That's 9 million. 999, eh? So it's approximately equal to 40, right? 40. Because it's that 9999. So which adds up to what we are given as the fair value in note at the first point, but you'll not be given the fair value. Because you're not given the fair value, this I will be computing the lease liability. Now, once you have the lease liability, the second step, we also need to determine the right of use asset. Right of use asset. And how to determine the right of use asset? Now, in this case, the right of use asset will be the same as liability. Why? So that to get the right of use asset, you'll take the lease liability. You add payments in advance. But in this case, we are not given in advance. We will be paying at the end of each year. This one only applicable when you are paying on the lease rentals are payable in advance. Then also, we say that you add any initial direct cost, which we are not given. So therefore, the liability we have computed is 40 million. Payment in advance was 0, since we are not paying in advance. Initial direct cost, we are not given any. So therefore, the right of use asset will be equal to the lease liability. This is what you show now initially as the value of the asset. Then you depreciate over the next 3 years. Therefore, how much will be depreciation per annum? So you take 40 million so that you depreciate based on the row of the economic life of the asset and the lease period, of which you told that both of them, they were 3. So by 3. So you get an amount of 16. 40 divided by 3, you get how much? Sorry, 13. Yeah, 13. Yeah, 3 recurring like that. Good. Now, how will you be accounting for this risk at the end of each year? Because remember, we'll be preparing the financial statement at the end of each period. So we prepare what we call now a lease amortization schedule. The same way we are preparing the loan amortization schedule, because leasing is the same as taking a loan. You have an asset and a loan. So, and how do we amortize? So here we have the period, which was for 3 years. We have the opening balance, that's the balance brought down. And then we determine the interest at the rate of 8%. Then the payments. The payment is made up of 2 elements, the interest and the principal. And then we have our closing balance. Good. Now, the payments, it's always an annuity because payment is what we agreed to be paying each year. And our annual payment was an amount of 15,521,200. That one does not change each year. It will be the same. Then we need to amortize. So what we are amortizing, a lease amortization schedule, we amortize the liability, not the asset. This lease or liability is what we are amortizing. We don't amortize the asset, we amortize the liability. So the balance brought down initially, this is what we recognized. The present value of lease rentals not paid at the commencement, which is 14. Then it will attract an interest at the rate of 8%, which is 3.2 million. Now, the payments comprise of 2 elements, the interest and the principal. So that means if you pay them 15,522,200, the interest is 3.2. So the balance is what reduces your debt, which will be the principal. So this is A, B, C, D. This is E. So therefore, to get the principal, you will take the payments. First of all, you deduct the interest, which is our B. So, and you get an amount of how much? 12,321. 200. Now, this is what will reduce your debt. Now, give me the balance carried down. So, to get the balance carried down, you take the balance at the beginning, you deduct the principal. The balance at the beginning, you deduct the principal. So, therefore, to get E, take A minus D. Sorry? 27? 678? 800. Then the balance carried down for the first period becomes the opening balance for the second period. So we'll have 27,678, 800. Interest at the rate of 8%. Sorry? 2 million? 214. 214,304. But the payment will be the same. So take the payment, eliminate the interest for the year to determine the principal. That in 306. 306. 896. Now give me the balance carried down. You take the balance brought down, you deduct the principal for the year. $14,371. 904. The balance carried down becomes the opening balance. We'll have 14,371,904. 8%. 1 million 249. 149,000. 752.
Yes.
Good. Take the payment, deduct the interest for the period to determine the principal for the period. Get 14. 371. 448. Now take the balance brought down, you minus the principal. You get a balance of 456. You always equate it to 0 because 400 is immaterial when it comes to 40 million. Good. Now the question is, now this how will be accounting for it. The lease amortization schedule. Now the question is, what do you take to the income statement, or how do you account it to the income statement? And then how do you account for it to the statement of financial position? So can you prepare to the income statement? I didn't show you on how to prepare the financial statement. Income statement extract. Now to the income statement, you'll be recognizing two things: depreciation and the interest. Depreciation and the interest. But in this case, we'll recognize 3 items, though these are special case, whereby there was gain on disposal. Gain on disposal, whereby you had 2016, 2017, and 2018. Yeah, the gain you recognize immediately an amount of 26 million. But being a liability, you also recognize the expenses. One of the expense, this is you are paying an interest, as well as you are the one depreciating the asset. Depreciation. Good. And these are the interest. Year 1, you paid an interest of 3.2. Year 2, you paid an interest of 2214, 304. And then 2018, you paid an interest of 1149, 750, 52. Good. Then depreciation per annum. You know, depreciation is an expense. So each year was an amount of 13 million, 333. Yeah, that's how you take it to the income statement. Only the two items, interest and depreciation. Now, in this case, the gain on disposal was a special case. At this level, you will not get a case of sell and lease back. Has already been taken to advanced level, not intermediate level. So you run lease excluding the sell and lease back, but the concept is the same. There's nothing special. Then, what about how do you prepare the statement of financial position? So to the statement of financial position, this one is an extract. (2016, 2017, and 2018). Now you see that to the balance sheet, you show two items. One, you capitalize, you show it as an asset, but note that it's not your asset. So you have some financial obligation you need to pay. You also show it as a liability. So let's start with the assets. How do you recognize the asset? So we have the assets, but we have a non-current assets. And in this case, we recognize a lease, sorry, or the right of use asset. The right of use asset. Now, this was the right of use asset initially, but we don't prepare the financial statement at the beginning of the year. We prepare at the end. So that means you recognize at net book value. So you take 40 million, then you deduct the depreciation for the first year, an amount of 13,333,333. You get an amount of 26,666,667. What about 2017? You take 26,667, you deduct the depreciation for the second year, and the balance will be an amount of 13,333,333. Then the closing will be the opening balance for 2018. Then you raise depreciation for the third year. So that means at the end of 2018, the balance will be zero. The asset has been fully depreciated by the end. Then there is liability. For liability, we have both non-current liability and a current liability. So non-current liability. Here we need to recognize a lease obligation. Also here we have a current liability, whereby we have a lease obligation. Now, what's a liability? Or for the liability, there are two. There is an non-current and a current. What's the difference between an non-current liability and a current liability? Now, a current liability is a liability or obligation which the company expects to pay within what? 1 year. That's very long. Yes. Less than 1 year. Very long. Within that financial year. Very long. Yeah, within the next one financial year. That's what we call a current liability. A current liability is what the company expects to pay within the next one financial year. Ukisema within the year, that one is no longer liability because we prepare the financial statement at the end of the year. So if you're able to pay within the year, it's no longer liability. Are you together? But at the end of the year, what we have not yet paid, but we expect to pay within the next one financial year is what becomes a current liability. Therefore, what is an non-current liability? Don't tell me it's the opposite of current liability. What's an non-current? Within the next 3 years. Yeah, hakuna kitu kama hiyo. Within more than 1 year. There is nothing like that. An non-current liability is any obligation that the company expects not to settle within the next one financial year. Not to settle within the next one financial year. That means it will take more than the next one financial year. Yeah, good. So therefore, to the non-current liability, you take the principal. Not the principal, sorry. But you take the balance carried down. Then to the lease obligation, you'll be taking the principal. I repeat again, that a current liability is what the company expects to pay within the next one financial year. So that means the obligation for 2016, you'll take for 2017, the next one financial year. So that means in 2016, the obligation is what you expect to pay within the next one financial year. You take for 2017. For 2017, you take for 2018. And in this case, we're saying that for the lease obligation, you take the balance carried down. So for 2016, you take for 2017. So for 2016, you take for 2017, and the balance carried down is an amount of 14,371,904 dash. Because for 2017, you take for 2018, which is 0. 2018, you are supposed to take for 2019, which is dash. What about for current liability? What the company expects to pay within the next one financial year? We take the principal. In this case, we have our principal. For 2016, you take for 2017, and the principal payment is an amount of how much? 13,306,890. Then for 2017, you take for 2018, which will be an amount of 14. Yeah, 371,440. 448, right? I repeat again that current liability is what the company expects to pay within the next one financial year. Now listen up here. This is the first year of operation, 2016, right? The balance was 4 million. Interest was 3.2. That's the first financial year. This was the payment. Of the payment, you see that it included the interest and the principal. We deducted the interest and we got a principal of how much? 12,321,200. So therefore, how much will be the balance at the end? The balance at the end, you took the opening balance minus the principal. Now this is the balance. This is the balance. Let me circle it here. After 1 year, how much will be our balance? Jamwambia mfikirie ni kuangalia. How much after 1 year, how much will be our balance? 14,370? That's very correct. Now I want us to do simple calculation so that I try to explain what I mean. By the end of this financial year, the balance was 27,678, 800, right? By then, after 1 year, that means at the end of the next one financial year, the balance will be how much? So there is a reduction, right? Now give me the difference. A reduction by how much? Take this minus 14. Give me the answer. What are you getting? 13? 306? Current liability. So that current liability is what the company expects to pay within the next one financial year. At the end of this financial year, this was the balance. At the end of the next financial year, our debt has reduced to 14. That means it has reduced by 13,306, right? Has reduced by that. So that means that's what we're able to pay within the next one financial year. Yeah, that's what it means. So from 27 to 14, that's a reduction by 13. So that means this 13 is what we're able to pay within the next one financial year. At the end of year 2, how much the balance? At the end of year 2, CDOE 14. So of this 27, we paid 13, right, together. The balance was how much? So that means 14, we are not able to pay within 1 year. That's why imebakia. So that means it will take more than 1 year, therefore becomes an uncurrent liability. And that's what we have indicated here, an uncurrent liability. You don't understand cramp. That is an uncurrent liability. You take the balance, carry down the principal. You can copy now. August 2022, question 4A. On 1st of January 2019, Breakwood Limited entered into a contract to lease an item of plant and equipment from suppliers for a 3-year period. The terms of the lease were that Breakwood Limited was to pay $500,000 each year, with payment commencing on 31st of December 2019. And that means is at the end. So we are paying in arrears. Initial direct costs incurred on the lease amounted to 30,000 shillings and were paid by Breakwood Limited. The branded equipment had a remaining useful for 5 years at the inception of the lease. The lease contract did not contain any purchase option for the lease. Breakwood Limited can borrow at the rate of 10% a year. Required. Analyze the accounting treatment of the above lease transaction from the inception and the 3-year period. Read that question again. So the first step we need to determine is the lease liability. You see that the lease liability is the present value of the lease rentals not paid at the commencement. So, and in this case, how much is the annual lease rental? 500. Present value interest factor of an annuity, the interest rate is 10%. The lease was for how many years? 3 years. So therefore it will be 500,000 times 1 minus 1 plus r raised to power negative n, that is 0.1. Give me that. Okay. 1,243,425, 426. Good. So that's the lease obligation. Then the next one, you need to determine the right of use asset. The right of use asset. How do you determine the right of use asset? Now, to get the right of use asset, you take the lease liability Then we say that you add any initial, sorry, before the initial cost, you add the payment in advance. Payment in advance. And then you add any initial direct cost. Lease liability, here we have is 1243,426. Payment in advance is 0 since we are paying at the end. And then you add any initial direct cost. How much do we incur initially? 30,000. So how much will we capitalize as the value of the asset? We get 1270, 73,426. Then this right of use asset is what now will depreciate. So you depreciate 1273,426 based on the ROA of the economic life of the asset, which was how many years? 5 years, and the lease period, which was 3 years. So the ROA of the two, that means we depreciate for how many years? 3 years. 424? 475, eh? Good. Then from there we can amortize. Prepare the lease amortization schedule. Here we have the period of the years. So 2019, 2020, 2021. Balance brought down. Interest at the rate of 10%. Then we have the payments. Then the payment is made up of both the interest and the principal. And we get our balance carried down, of which that payment is an annuity. This one does not change, of which we had agreed that we'll be paying an amount of 500. Now, how much was the balance brought down? The balance brought down was an amount of how much? Sorry? 12? Is it 43 or 73? 70? Not 73. I repeat again, we say that we are amortizing the liability. Are you together? Not the asset. Asset we are depreciating. Good. So the liability is what we are amortizing. So it's 1243, 426. Then we pay an interest at 10%, should be 1243, 43. Then the payment is made up of both the interest and the principal. So you take the payment, you deduct the interest to determine how much was the principal. It was an amount of 375, 657. Good. Now give me the balance carried down. By taking the balance brought down, you deduct the principal. Eight, 6, 7, 7, 6, 9. The balance carried down becomes the opening balance. We have 867, 769. Interest at 10%, 86,777. 500, you deduct the interest, you get an amount of 4. For 223. Now take the balance brought down, you deduct the principal to get the balance carried down. Four? 545, eh? 46. The balance carried down becomes the opening balance. So 45, 45, 46. Interest will be 45,455. Payment minus that, you get 454. 545, eh? Take this minus the principal. Get a balance of 1, right? So you equate it to 0, good. Now, how do we account for it? So what do you take the income statement? What do you take the balance sheet? So that with the income statement extract. We have the expenses whereby we have the interest expense and the depreciation. So these are the interest expense. We have 124, 343. Here too we have is an amount of 86,777, and we have 45,455. Then depreciation per annum is on a threatened basis. We get an amount of 424,475. 424,475. 424,475. What about the statement of financial position? So so we have the assets, non-current assets, where we have the right of use asset. Now for the right of use asset, so this is the right of use asset, an amount of 12,73,426. But this, the value was on initial recognition, on initial. What about subsequently? Subsequently, you say that use the cost model as permitted by IAS 16, cost minus any depreciation. So you take the initial recognition, but this asset is depreciating. So there's depreciation, 424,475. So that now we recognize them at net book value, or what we call the carrying amount. 840? 951, good. You take this, you minus depreciation for the second year. Then we have non-current liability, whereby we have a lease obligation, as well as we have a current liability. We also have a lease obligation. Now, those who are good in cramming, what do we take to the lease obligation as a non-current? Balance? Yeah, balance carried down, correct. To the current liability? The principal, good. See that liabilities, it's all about the next one financial year. So for 2019, you take for 2020. So for 2019, you take for 2020. So to the balance carried down here, you take 454, 546. Then for 2020, you take for 2021, which is an amount of 0. Even 2021, there will be no any liability. To the current liability, principal is what you'll be paying next financial year. So for 2019, you take for 2020, but now the principal, an amount of 413,223. Then for 2020, you take for 2021, an amount of 454,545. Can copy? Now write something. Now what? Lease accounting by the saw. Lease accounting by the saw. Now someone is asking whether is there a possibility that the economic life can be less than lease period? Help me to answer that. Have you understood my question? They're asking whether economic life of an asset can be lower than the lease period. Can it be? Just think of that. An economic life of an asset is 10 years. You lease it for 20 years. Can it happen? It can't happen. If the economic life, there is a what? There is a breakdown. Now, if there is a breakdown, does the economic life increases or reduces? So it can never. An asset economic life cannot be 3 years. How can you know that? This laptop should be used for 3 years. That's the economic life. Then you lease it for 10 years. That one is not possible. That one is not possible. Now, lease accounting by the lessor. We like to say that the owner of the asset under lease, the owner of the asset under lease, the owner of the asset under lease, the owner of the asset under lease recognizes interest income, recognizes interest income and capitalizes, you see that to capitalize is to include an asset, an item as an asset, and capitalizes lease investment, capitalizes lease investment. Okay, this is what I'm trying to mean. Now, in this case, this company leased an asset, right? So this is the lessor. You expect to be paying the interest. Now, you are the lessee in this case. What if I'm the one? I was the owner of the asset. Now I'm the owner of the asset. How will I be accounting for this asset? For you, you'll be paying the interest expense. Who is receiving this interest? Yes? The owner. Are you together? Good. So in case it was owner, for example, in this case, we are told that, how should an owner account for it? So now the process is the same. This I shall recognize. The owner does not use the asset. He only owns the asset. Are you together? Who is using the asset? The receipt. So therefore, as the owner, there is no right of use asset. Nothing like that. There is no right of use asset. Therefore, you are not the one depreciating the asset. The person to depreciate the asset is the one using the asset. Therefore, there is no depreciation. Then, here there was a lease liability, according to you. But according to me, it's not a liability. To me, it's because this is the amount you expect to pay in the future. But to me, is the amount I'm expected to receive in the future. So therefore, instead of liability, I recognize a lease investment. So therefore, the lease investment will be equivalent to the present value of lease rentals not received at the inception. To you was a liability. Therefore, it was the present value of lease rentals not paid. So to me, not yet received. So it will be the same. Then the schedule will be the same. The schedule will be the same. The only difference will be here for the interest, instead of interest expense, to me, it will be an interest income. Instead of payment, to me, it will be receipts. That's the only difference. To me, interest income instead of interest expense, and then you are the one paying. That means you are paying to me. So to me is the receipts. Therefore, how does it affect the financial statement? So to the financial statement, the owner does not depreciate the asset since you are not the one using the asset. Therefore, there is no expense for you, an investor. So you recognize an income, which will be the interest income. The interest that was expensed to you, you are paying me the interest. So to me, it's an interest income. What about the balance sheet? The balance sheet, I'm saying that I'm the owner, I'm not using the asset. So therefore, there is no right of use asset. You as the receipt, you recognize an uncurrent liability and a current liability. What is current liability? The amount you expect? The amount you expect to pay within the next one financial year? So the amount you expect to pay within the next one financial year, to me, is the amount I'm expected to receive within the next one financial year. So therefore, here, instead of non-current liability, I recognize a non-current asset. And here also, I recognize a current asset. Also, the terminology will change. Instead of lease obligation, it's a lease investment. Also here, it's a lease investment. But the same concept remains. To the non-current, you take the balance carried down. To the current, you take the principal. Good. So now, I want to do another illustration. So take a screenshot of this. Take a screenshot, then you leave a space where you'll copy that. So just go and copy this illustration. August 2022, now you copy, assuming that now we are the owner of the asset. So what if now you have a lease when you are paying in advance, the lease that you are paying in advance? So now open August 2024. August 2024. Question 5. Question 5. Yeah, for payment made in advance. So question 5A. So 5A, you're told that Top Limited, a construction company, entered in a leasing agreement on 31st of December 2023. 31st December, so that's the end. For a piece of equipment costing 94,920 with Zook Bank Limited. The lease requires Top Limited to pay an annual rent of 27 to 20 payable in advance. So this case will be paying the lease rentals in advance instead of in arrears. The primary period of the lease is 4 years. At the end of the primary period, Top Limited has the right to extend the lease indefinitely on a payment of a nominal annual rental. Top Limited believes that the equipment will last for 4 years and will have no scrapped value at the end of this period. So the lease period is 5 years, is 4 years. Also, we expect the economic life to be 4 years with no scrapped value. Top Limited depreciate asset of this type using straight-line basis. Top Limited, and Zook Bank have accounting periods ending on that 1st of December. The implicit rate of interest is 10%. Read that question again. So the first to determine is the lease liability. Now, this contract is for how many years? The lease is for how many years? 4 years. And then, how much do you expect to pay each year? Yeah, 27 to 20. Good. Then we discount present value interest factor of an annuity. The interest rate is 10% for 3 years. So it will be 27 to 20 times 1 minus 1 plus R, 0.1 raised to power negative 3 over R, 0.1. So give me that. You're getting an amount of 4 years. Oh, it was 4 years, eh? The teacher is always right. Give me the answer. Know that the teacher is always right, eh? You're getting an amount of 67, 692, 111, right? And now let's go back to our notes. The first page you wrote about lease liability. Lease liability. Are we there? I want you to read what you wrote, not what I said, what you wrote. What's the lease liability? Just read what you wrote. It's a soma na nguvu. Initially will be measured at present value of lease payment not paid at the commencement, full stop. Not paid at the commencement. Now, this contract is for how many years? Yes, year 1, year 2, year 3, year 4, of which we agree we'll be paying an amount of 27 to 20, 27 to 20, 27 to 20, 27 to 20. But not that we are paying in advance. So that means for the first period, before you get the asset, you paid a deposit of how much? 27. What is the liability? Liability is what you expect to pay in the future. You have already paid this. It's no longer liability to you. Are you together? You have already paid the first installment in advance. So to you, it's not a liability. That's why I say that a lease liability will initially be measured at present value of lease payment not paid at the commencement. So at the commencement, for you to get the asset, first of all, you paid a deposit of 27, the first installment. Therefore, the liability is what now you expect to pay for the remaining 3 years. That's why I'm saying that the teacher is always right for 3 periods. Then from there, now let's determine the right of use asset. And how do we get the right of use asset? Say that you take the lease liability, which is an amount of 67,692,111. And then we add the payment in advance. What you had paid initially, we don't discount because it was already at its present value. How much had we paid initially? 27, the first installment. So an amount of 27 to 20. Then you add any initial direct cost. Are you given any cost? No, it's 0. So add that. 94, 912, 111, which is almost equal to the cost of that plant. Can you see the cost of plant? Yeah, which was 94 million. So this is what you will capitalize, which is equivalent to the value of that property. Then we amortize, so we prepare the lease. But before that, we need to depreciate. Depreciation per annum will be 94, 912, 111. You depreciate for how many years? 3 years. Good. It was for 3. Is that 3 or 4? Okay, the lease period was how many years? And they not 3. The lease period was 4 years, right? Which was also the economic life. So you depreciate for 4 years. 23, 728, 028. Now we can prepare a lease amortization schedule. Now, the format when you are paying in advance and when you are paying in arrears, the format are different. Because when you are paying in arrears, the initial amount, the right of use asset, or the lease obligation will attract the interest for the entire year. But in this case, this is how you account for it. So period for 4 years, year 1, year 2, year 3, year 4. So we're having the balance brought down, then we are paying in advance. So we pay first. And that's how we determine now the balance due. Now, this balance due is what now will attract the interest. So we determine the interest, and that's how we get our closing balance. Balance coming down. And how much is the balance brought down? I'm asking that question again. How much is the balance brought down? 67, correct. We are amortizing the liability, not the right of use asset. An amount of 67, 692, 111. Then we are paying in advance. Those are the lease rentals. So how much is the payment? It's 0. So you get 67, 692. For the first period, you had already paid. Are you together? This 67 was for 3 periods. Why? Because we had already paid this 27. So the first period, before you had gotten this asset, you had already paid the first installment. So you are not paying again. So the balance due, which is now your liability, is this 67. Then this 67 is what now will attract an interest at the rate of 10%. So the interest will be 67, 69 to 11, right? One more. Now, to get the balance carried down, now this was your balance due at the beginning. Then it attracted the interest. So it increased your liability. So you add the interest to get the balance carried down. So let me call it A, B, C, D, and this is E. So to get E, you take C, the balance due, you add the interest accrued during the year. How much will be the balance? This plus the interest for the year? $74, $461, $322. The balance carried down becomes the opening balance. So you'll be having 74, 461, 322. That's the balance brought down. But now you are paying in advance. You start by paying an amount of how much? Yeah, 27 to 20. How much will be the balance due? Sorry? 241, 322. This was the balance due. because you had paid in advance. After you pay, this balance due is what now will attract the interest for the year at the rate of 10%. So it's 47, 241, 32. Good. How much is that? So you take the balance due, you add the interest accrued for the liability. How much do you get? $50? 965? 454. The balance carried down becomes the opening balance. We'll be having 51, 965, 454. Then we pay in advance an amount of 27 to 20. Pay that. How much will the balance due? 24, 745, 454. Now, this balance due at the beginning of the period is what now will attract an interest at 10%. So it will be an amount of 2474, like that. Good. Now take the balance due, you add the accrued interest for the year, your liability will increase. Sorry? 27. 27, 219, 999. And then you have 27, 219, 999. And then the payment is how much? 27 to 20. Give me the balance due. You see the difference here is 1 shillings, right? So in short equivalent. For my deals, so this one should be 220. So it will be 220. The difference is 1. So let me just open with it. So it will be 27. How much is the balance? 0. How much is the interest? 0. Good. How do we prepare the financial statement? Now you see in this case, the payment was only 3 of them. This. Why? Because we had already paid this one at the beginning. So how does it affect the financial statement? Income statement, extract. So period 1, period 2, period 3, period 4. So here we have the expenses. For the expenses, number 1, we had the interest, and then we have depreciation. So here is the interest, amount of 67, 69 to 11, 47, 24, 132, 24, 74, 545, 0. Depreciation is on a certain basis, so it will be an amount of 23, 728, 028. What about the statement of financial position? So we start with the right of use asset. So we have the assets, non-current assets. So non-current assets, we have the right of use. Now, yes? I understand the question, but now, when do we enter into contract? 31st of December 2023. Are you together? So, when is our year ending? The reporting date is still 31st of December, right? So that means if we entered into contract on that 1st December 2023, when you recognize that transaction in your financial statement? Okay. What's the difference between that 1st December 2023 and 1st of January 2020? Is it the same? We entered into contract, and this is what we're supposed to recognize. But you're not recognizing at the end of the year, at the beginning of the contract period. Are you together? It's the same the first question we did. When we sold and then we leased back, we sold on 31st of December 2018, so that the contract commenced on 1st of January 2019. But in case we have to show this, I'll show you that. Okay, first of all, let's finish this. I'll show you what I meant. So for the right of use asset, this is the amount of 94,912,111. We deduct the depreciation of 23,728,028. Give me the net book value for year one. Hey, engage your calculator. $71,884. 080. Minus depreciation for the same period. 184. That depreciation for the second period. $47,456. 055. I deduct for the third year. Then we have non-current liabilities, whereby we recognize a lease obligation. Also, we have a current liability. For the current liability, we also have a lease obligation. Now, we had said that if you're paying in arrears, to the non-current liability, you take the balance carried down, to the current liability, the principal. When you're paying in advance, so that means you are clearing your liability in advance. So to the non-current liability, here you'll be taking the balance due. Then to the current liability, what you expect to pay within the next one financial year, and those are the payments. Good. So for period one, the liability will take for year two, and in this case, the balance due. So here you have an amount of 47,241,322. For period two, you take for period three, which will be an amount of 24,745,454 dash. Then to the current liability, what you expect to pay within the next one financial year. For example, this was the balance at the beginning, at the end, which was the opening balance. Then we paid immediately an amount of 27. So that's what we expect to pay within the next one financial year. So in this case, you take the payments, the 3 payments. That means for period one, what you pay in the next one financial year, this is our payment, is an amount of 27,220. For period two, you take for period three, which is still an amount of 27,220. Then for period three, you take for period four, which is the same 27,223 payments. Good. Now, I want to answer the question you had asked. Now, let's read the required. Show the above transaction. Show how the above transaction will be reflected in the statement of profit or loss, that's the income statement, for each of the 5 years, ending that 1st of December 2023. That's when we entered into contract. So we have 2023, 2024, 2025, 2026, and 2020. Those are how many years? 5, but they are not 5, they are 4 years. Are you together? Because when did we enter into contract? 31st of December 2023. So you are leasing an asset, uanza kutumia hiyo mwaka? No, so that the difference between 31st December and 1st of January, so this was the first period. So 2023, the only thing maybe you can show is to the balance sheet, and that's what we call on initial recognition. This is what I mean. So if I was to add here 2023 to the balance sheet, the right of use asset, that's the only thing that will affect. So here the value of the asset, right of use asset, initial recognition, this is what I'll show, without deducting any depreciation, an amount of 94,912,111, without any depreciation, because we have not used, we have just entered into contract. Then 2024, and that's what I have done here now, you take 94,912,111. This was the first year of use. That's when you depreciate. You could have deducted the depreciation to get an amount of 71. This is hapa. So hakuna mambo ya miaka tano. If you are to show, this is the only thing you could have shown at initial recognition. But now you can copy. I want to give you an assignment. Go and try this question. Assignment, handout question 1, page 1. So that marks the end of that topic.